Secrets to Abundant Living podcast community. Welcome back to another episode. We are deep into season 2 here, and I'm excited to do something a little bit different, which is to share a webinar that we did for our investor club here at Sylvis Capital. As you know, I run a real estate private equity firm where folks can invest in hands-off real estate alongside of us. And the purpose of sharing this is, as we've talked about many times in the episode, hands-off income can be a powerful tool to living your abundant life, to having more control over doing what you want, where you want, when you want, with whom you want, for however long you want. And we love education and data-driven strategies at Sylvis Capital. So I really wanted to share this webinar because it is so powerful. And I'm not sure that many people are being exposed to this type of analysis. So just as some background here, the broader United States and global economy impacts us as investors. And we have a new administration. This is not a political podcast or webinar, but simply there are changes that are happening. And savvy investors always want to keep abreast of what these changes are and what they might mean for their strategies for preserving, protecting, and of course, growing their wealth and their hands-off income. So we have invited two amazing gentlemen, Bruce Fraser and Matt Hock of Elkhorn Capital, who have stunning experience in the broader investment space, not only in real estate, but in other investments as well. So their ability to look at economics, their educational background, their decades and decades of experience really allows them to cut through the noise and understand what metrics, what data we should be following, what that information needs, and how we can incorporate that as sophisticated investors. So if you're not part of our investor club, you may not know these gentlemen, we actually purchased a 200 unit plus apartment complex at the end of 2024 in Tulsa, Oklahoma. So not only are these gentlemen guests at this webinar, but they're business partners of mine. So I am so excited to give you this exclusive insight into the education that we like to provide folks. And, you know, what is so interesting about this private equity world, if you're not familiar with it, is all of this information isn't always readily available just in terms of these private access webinars, these private access investments. So it just feels really great to be able to share those with this community. Okay, I'm going to put the links, their contact information in the show notes. So make sure to check that out. And this is going to actually be a 2-part series because this webinar is so full of such great information. I want to make sure you can sink your teeth in, digest it, and that will be best done over 2 podcast episodes. So enjoy and looking forward to your feedback. We'll talk to you all soon.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. Get ready for empowering conversations, expert insights, and real-life stories that inspire you to live abundantly. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Welcome, everyone. We're excited to have you for our Economic and Real Estate Trends webinar. This has been several months, couple months in the making. There is so much going on, and we want to make sure we give you a sane and data-driven perspective on what is going on. There's quite a bit of news, and we have 2 incredible guests that are going to be able to walk us through what they're thinking through in this coming year in both just macroeconomics, but also real estate as well. So I actually see a few new names, which I was very excited to see. So we're going to do introductions first for those of you who don't know us, and then we're going to dive deep. This is going to be a little bit more casual, just in that we don't have formal or extensive formal presentation slides like you're used to us having when we're presenting a deal. We're keeping it conversational, but definitely make sure if you've got questions, put them in the chat. We'll make time. For those of you who don't know me, my name is Amy Sylvis. I am the founder and principal of Sylvis Capital. We have around $330 million in assets under management, mostly in multifamily real estate, some flex industrial as well. And we connect investors to exciting investment opportunities that are hands-off in commercial real estate, namely one that we just closed with these two gentlemen at Elkhorn Capital at the end of 2024 in Tulsa. So I'm excited to introduce you to Bruce Fraser and Matt Hock. For those of you who don't know who they are, I'll let them give a little bit of information about them, but I want you all to understand the context of their incredible track record in not only real estate, but in investments in general. And their data-driven approach and track record is just exceptional. So the honor to be able to bring these gentlemen to us to give us insight into what they're thinking through, just wonderful. So thanks again for taking the time, Bruce and Matt, for joining us today.
Good. A lot of pressure not to say something stupid.
Just want to make sure I do you all justice. It's weird to toot your own horn. So I want to make sure folks know the gift that your presence is today.
Thank you.
Appreciate you having us.
Wonderful. So can you tell us both just a little bit more about yourselves, your background, a little bit about Elkhorn, just to set the context, if you wouldn't mind?
Sure. Yeah, I've been a professional investor for other people's money for decades now. I originally started a hedge fund. It was what's called an absolute return strategy, trying to make a steady return no matter what. People hear hedge fund and they get scary risk, but we're just really low vol, trying to make a dollar and put it in the pile and never give up a five. And did so for a decade really effectively, and including going through the financial crisis, peak to trough. I think we were -2, -2 and change in 08, and back at our all-time highs at the trough in 09. You do something like that for investors and you gain a lot of trust, obviously, because most people didn't anticipate that coming. And frankly, we really had been nervous about the markets for a while because we were looking at the data and what was going on. And a lot of people were taking risk and exposure that they shouldn't have been taking. But I had been an investor in real estate for years, but I ended up selling all of my investment real estate in 07 because of the research we've been doing in the hedge fund, and took all of my chips off the table. And in retrospect, obviously that was really good timing. A lot of people say it was lucky, but again, we were looking at data, we were looking at price to rent ratios and things like that. And it just was, things were absurd and hyperbolic. And so we figured it was a good time to take our chips off the table. I formed Elkhorn in 2010 and started re-entering the market based on, again, back to the financial crisis. I felt pretty confident the Fed was going to start printing money and monetizing its own debt. It was really probably the only mathematical path. So we were pre-positioning for the inflation that we felt was coming. And there are a couple of different ways to protect yourself from inflation. We can dig into that later, but real assets or hard assets are one of the ways to do that. And we felt that the risk reward in multifamily was really the best that we saw. So that's why we focus 100% of our attention now on multifamily. We don't do other things. We just stay in our lane and, keep our head down and try to get the results that we expect.
Incredible. Thank you for that.
One added time, Matt jumps in. Elkhorn at this point, we do come at it. We're a little bit more sophisticated than some other operators with the data and the way we run things. We vertically integrated almost 2 years ago. We're not pleased with the third parties that we had available to us, and we weren't getting the results we wanted. And when we took over, and this is largely due to Matt's efforts, just the results skyrocketed when we were in control and being thoughtful about how we do comp plans and monitoring the things that are important. And so that was super helpful, but also we have lending partners that they understand our success in the past and how we approach things, and they really value that. And so when there are deals at the table, we had in fact had one lender that had already sent something to underwriting for a different operator, and then they knew that we were at the table and they deleted that and went with us instead. And so because they felt more confident putting their money behind us than the other operators. So that goes a long way, but over the years, we developed a specialty in distress situation turnarounds. And you call me crazy because it is a ton of work to take over a property that's 30% occupied or half the units are hard down to the studs. But to us, it's a clear path to money because you have something broken, if you fix anything, it's going to be worth more. And so we're not having to hope that a new amenity is going to drive the results that we want someone's willing to pay us for. We're just bringing units back online in many cases. And so with that expertise, we can look at situations that are easier. Like if it is just 100% classic deal, more traditional kind of value add, we know exactly what we're looking at, how much we're going to spend, and because we spend so much money in CapEx normally. So that's been really valuable to us as well.
I love that you mentioned the vertical integration. For those who aren't familiar with that, in apartment buildings, you have really two options for how to manage the property. You can hire a third-party property management company, which has its benefits and risks, or you can do what Bruce and Matt did at Elkhorn, which is bring the property management in-house and run the property management company yourself, which gives you tremendous control. And I don't want to put words in everyone's mouth, but I think you found gives much nicer outcomes just in terms of efficiency, resident experience, operating, getting to your business plan, all the above. Is that right?
Absolutely.
Okay. Excellent. Thanks for that, Bruce. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show.
I come from a traditional trust company background where I was running the custody department for alternative assets. Individuals were using their IRAs to invest in alternative assets, which led me to be introduced to Bruce, and I got a chance to watch everything that he was doing. And so after about a decade and a half of doing that, I jumped over to the real estate side with Bruce, and I've been here ever since. And that's what led me to see. I got to watch a lot of people doing things correctly, and I got to watch a lot of people blow up a lot of deals, unfortunately, just through all sorts of different alternative assets. And so that kind of led me down a path of seeing who was doing things correctly, and that led me to working with Bruce. And so it's been just history ever since after that point.
You all make a fantastic team, and you both are very responsive to all my questions and requests for information as we work together too. So that's greatly, greatly appreciated. Well, wonderful. Given that background, and again, everyone, we're gonna go through several topics like inflation, interest rates, tariffs, unemployment, just all sorts of topics. But as we go, please make this interactive. Put questions in the chat. Take advantage of these brilliant minds that we have with their great track record to see what they're thinking through for 2025 and beyond. So I will kick us off with, I think, one of the biggest topics. If you don't follow Bruce on LinkedIn, I highly recommend that you do, because he talks often about this concept of inflation and the national debt, not necessarily tied, but can in some circumstances be tied. But Bruce, can you talk to us a little bit about what you're seeing in the national debt macroeconomically coming and how that might relate to investing as well?
Yeah, sure. I mean, and that's the whole reason our investment thesis. It's why because I am the principal of another investment firm as well, but I spend vast majority of my time with Elkhorn in capital, and that's because of my views, and I believe that's where you should be positioned. My kind of sign off on all my posts are positioned accordingly, and we try to share as much information as we can, and really cull it down, because not every, I have an eco-finance undergrad degree and a master's of finance, and not everybody has that background to be able to look at the data that we're seeing and really cull out the noise or the narrative, the headlines, because oftentimes the talking pundits are just not conveying the full story. There's someone famous out there for dollar milkshake theory, and what he's saying is the dollar is going to be better than all the other currencies, but that's not really the point. It's like, what can we buy with the dollars? We're absolutely losing purchasing power if we're doing it at a lower rate than the yen or something. Like, who the hell really cares? I still can't buy as much stuff. And so I think that we really come at it from a position of, we believe macro is so incredibly important, because it's the analogy is, it's a stream that's running very fast with a current can you swim upstream? I mean, you can, but it takes a lot of effort and it's really hard and you're going to get exhausted and you may drown. And so it's a lot easier to try to identify that current and which way it's going and just jump in. What I'll say is in a good, strong market, that current can make someone look like a much better swimmer than they actually are. And we see that. It's really at the major turns or when they slow down, when you can really tell who the strong operators are and who just timed it and got lucky. And we've seen a lot of operators in pain because they got some things wrong. But to your question on the U.S. government debt, I mean, the debt at this point is approximately $36 trillion. And if I gave you an exact number, it would change every second because it's going up so rapidly. To put that in, I mean, the numbers are just enormous. And so to put that in context, there's the graph.
Yes.
You can see it's just a shocking graph to look at. It's just exponential and it's unsustainable. There's no question because to size that, the U.S. government takes in taxes all revenue of about $4 trillion a year, but they're spending about $6 trillion a year, at least currently. And so every year we're going further into debt by $2 trillion, and that's before we pay interest. And so we're borrowing to pay for all this stuff, and then we're also borrowing to pay the interest. For those that are familiar with real estate, this debt is non-amortizing, and so it's not being paid down. All these massive payments are just going to pay the interest. And so go to your banker and say, I need to borrow just to pay my credit card bill, just the interest on it, and see how they respond, because that wouldn't be a good conversation. The growth rate of the debt right now is about averaging about 8%. And so it's compounding very, very rapidly. And the world was really starting to notice, I think, and we can dive into it a little bit more, but this whole discussion with Doge and what they're doing, clearly they've already identified just a tremendous amount of waste. That's going to have a big impact. But the reality is that they're targeting $1 trillion in expense, which is phenomenal. I'm thrilled because no one's ever really done that before. But that still leaves us a $1 trillion deficit that's not being resolved. And so it slows things down, but it doesn't fix it. And also, you have to take into account the current administration also has, I don't know if promise is the right word, but they've mentioned multiple different kinds of tax, eliminating certain taxes on that, on veterans, I think, and on tips for waiters and waitresses and all different things. And I've seen that estimated to be about $1 trillion. So this $1 trillion they're going to save, maybe turn around and give them back. And so we may still be running a $2 trillion deficit even when Doge is done. And so we'll have to see how that goes forward. But the question is, who in their right mind would loan the U.S. government money long term and at 3 or 4%? And the answer is, it's really only been, the buyer of size has been central banks. And individual investors really don't matter because they don't have the same size bazooka to spend money with. But if you look at what's happening in that trend, and I think I gave you this graph too, but the central banks' appetite for treasuries has been declining, and actually that decline has been accelerating. It's down and to the right, which is at the same time as we're issuing more and more debt, needing more and more buyers. The big buyers are all saying, no, we don't want it. And so a couple of things caused this. One is just the long-term inflation that we'll talk about more, but if you're holding paper and when you get repaid, you can't buy as much with it. Well, that's not very compelling. The other thing is in the first quarter of 22, you'll remember we did some sanctions on Russia for invading Ukraine. Well, what we did, formally, Russia, like every other country, held significant dollar reserves. Those dollar reserves are usually held in treasuries. We basically took that money from them. It was the first time that line has ever been crossed, and took away their reserves, just basically deleted it. And that sent a shock throughout the world, not just with Russia, but with even our friendly partners. And so that's what caused that graph. Everybody started selling their treasuries. And if you flip that graph over, what are they replacing it with? Replacing it by voraciously buying gold. And so at the same time in 2022, there's something that went into effect. I don't want to discuss it much because it's too in the weeds, but something called Basel III. And that allowed gold to be classified as a tier 1 asset, why it hasn't been forever, I have no idea, because it's the most stable stored value there is for thousands of years. But for whatever reason, the International Bank didn't decide it wasn't, but that went into effect in 22 as well. So those two things combined really resulted in a negative trend for dollars. And so that down to the right, it just means there's fewer demand for dollars. Now, it's not a straight line, and there's some up and down based on what's going on in the world and things like that. But I'm a big believer in supply and demand of things when we talk about that related to markets or properties or anything else. But if demand for dollars is going down, I don't think there's a lot of discussion about de-dollarization. whether we would lose world reserve status. And that's one reason we were able to get into this position. Post World War II, we were the biggest, baddest country. We'd come to the rescue of the world, and we had 2/3 of the physical gold reserves. And so it made sense to create a monetary system based on the dollar at the time. Well, the plague of that is that you can just print money like endlessly, spend at will, and you really don't run into a constraint until it just gets absurd, and we're at the absurd level now. And so I don't think that it matters whether we lose. Well, it would matter, but it's not necessary that we lose that world reserve currency status for there to be a lower demand in dollars. I mean, that would further accelerate it, but if the demand is down and to the right, it's going to hurt purchasing power. That's why bringing it home, that's why we focus on hard assets. We trade those paper dollars for something that's real. And I actually have a peer group of operators that consider most of them top decile operators. And we were at an offsite early last year, and I remember one of them saying, "Hey, I read your stuff. You say multifamily is a great inflation hedge. I'm getting killed." I'm like, well, you did it wrong. The whole point of a hedge is trying to fix as much of your expense as you possibly can, i.e. your debt, and then be in a market where you have pricing power so you can raise rents with that inflation. And this particular individual had invested heavily in a market that we would never invest in just based on the data. And the supply is just continuing to come on and on and on. And they were on floating rate debt. And so they were getting it on both sides. But anyway, they got it wrong. So that's not how we do things. We prefer fixed rate debt. We don't do floating. It's not that floatings can't be used. It just, when you could borrow at 3.5% for 10 years, why wouldn't you? There might be some downside in rates, 50 basis points max probably, but there's asymmetrical risk there. And so we would rather just put it in place and fix it and know that we're going to be okay through the ups and downs.
So, Bruce, how do we fix this? I mean, if magic ball or magic crystal ball, how does this end? Because to your point, Doge, again, this isn't meant to be political. This is a data-driven discussion. But to your point, if we're negative 2 trillion every year, we're adding on 2 trillion, if I understood what you're saying correctly, on an annualized basis, the debt keeps growing. How do we get rid of it? What does that look like? Do we inflate it away? Is that our only option, Bruce? Do you think?
I mean, I've publicly said there are 4 options.
Okay.
Honestly, there's probably 5. The 5th one was never really a consideration until some of the changes that I've heard contemplated with the current administration. But, you can raise taxes. A lot of people shout out, "Oh, you got to raise taxes." Well, I told you 4 trillion is collected by the U.S. government, but only about 2 trillion of that is from income taxes. And so even if you double taxes, which would be more than 100% of collections for some people, obviously that can't solve the problem mathematically. You could cut expense, and I'd always said, well, that's very infeasible because politicians always talk about it and never do it. A lot of people were, I think, shocked by what's going on right now because that's the way it always happened. People would discuss it, they would pound on the table, but nothing would ever happen. And I think there was an expectation that even with this new Doge organization that they would propose a lot of stuff and a lot of it wouldn't get passed or put through. I don't think anybody was really contemplating a situation where they were just put in a position where they could just go. So that's shaking things up. But anyway, so the expense side, even so, we can't cut our way. We could cut our way potentially to a neutral deficit, but that doesn't pay off the existing debt, and debt of which is resetting every day at the new higher rates. And so the current interest expense is 1.2 trillion, but if we stay at this level for another year or so, it'll jump to probably 1.6 trillion. And so that's becoming a very large percentage of our income tax collections. So those are 2 options. The third is just to explicitly default, just say, you know what, wash your hands. We can't pay this debt. That's not going to happen. Just print more money first. If you look at every country in history that has done something like this, they will sacrifice the currency before they sacrifice on the debt. And so that leads us to the 4th thing that they can do, and that's inflate. And by design, they need inflation, and they need a relatively high inflation rate so that they can pay back the debt with future dollars that are worth less. And so, because no matter what the inflation rate is, they still only owe the face amount of that bond or that T-bill. And so that's always been the game. And that's why if you look at the CPI calculation, we laugh at it because they've redesigned that calculation dozens of times over the decades. And every single time it's resulted in a lower number. Well, now mathematically, if you were making honest tweaks to the calculation, sometimes it would go up based on your change, right? And it never has. And so, in fact, Matt, correct me if you remember when it was, but I think it was January 22, they changed it. Might have been January 23. But when we were right after we were having that massive spike in the CPI that they couldn't even hide with their magic calculations, they changed the calculation because it used to look back and compare it to prior years. Well, you only compare it back to the prior year where we'd already had a big spike in inflation. It made the number suppressed and made it look better. So now there's a 1-year look back instead of a 2-year look back. But even with that, the most recent print in January, if you look at the month over month or the year over year CPI hit a 9-month high at 3%. And if you look at the 1 year, the month over month change was 0.5%, which annualizes to 6%. And that's an 18-month high. So clearly the Fed doesn't really have inflation under control, even with their with a disingenuous calculation of CPI. Inflation, they need to have it, but they can't show it because people get angry and it's pitchforks and torches time. Kind of like what we saw a couple of years ago. People were getting really angry because hardworking people just couldn't afford the things that they wanted to. They don't want to switch out a steak with soybeans or something like that. They want their steak. And now they can't afford it. A lot of families were really squeezed by that. So, but the other scenario that I've never really talked about is you could have a scenario where, because our debt to GDP is about 20% right now and going higher. And even the U.S. government accounting group is saying that's going to just continue to escalate. And they've always been wrong to the downside on their numbers. And so it's probably a lot worse than the CBO says. But the other scenario is you could grow your GDP faster than the debt growth. And so if our debt's growing at 8%, but let's argue maybe they don't do the tax cuts and they just get this extra chilling out. So our debt growth starts slowing some. If we could grow GDP faster, it doesn't pay off the debt, but it allows that ratio to become more and more manageable over years. Now that would take decades, but if you're heading in the right direction, market probably allows you some room to do that. And again, that's not a scenario that was ever really seriously a possibility, but massive deregulation like what's being discussed and some of these things, that could spur a really strong GDP growth environment. We'll have to see, but 30% of the GDP is comprised, 30 to 40, depending which or agencies you're looking at, but comprise GDP. It's 40% of governments in aggregate comprise 30 to 40% of GDP spending. And so if you're massively cutting where that spending is going, cutting the government spending, then you have to not only grow the GDP, but you have to make up for that what would be a retraction as well, because $1 trillion on GDP, that it's not immaterial. And so you would really need a scenario where it's upper single digit GDP growth, if not higher. And we've never seen that, but awesome.
Great insight. It seems to, well, if you were a betting man, instead of giving my opinion, if you're a betting man, what would you think? What do you think?
I'm an investor, so I am a betting man.
Yes, there you go.
probability weighted. And so highest probability is to see what they've always done, and what they've always done is inflate. And so I'll bet with that, and that's what we're doing. We're buying hard assets and fixing as much of the cost as we can. And even to the extent of looking at doing multi-year contracts with some of these vendors, fixed price, so that we know we're going to be in business for a few years. So yes, why wouldn't we fix as much as we can? Because that's the bet we would take.
I love that outlook of, I don't think anyone wants higher inflation for longer, but we can only play the cards that we're dealt. So then
socially, I hate the impact. Sorry to interrupt you, but socially, I hate what's going on. But at the same time, I want to position according to the highest probability view. And that's what we believe that is.
Precisely. Yeah. It is a regressive tax on the poor, who I don't think anyone wants to see them in a worse situation, but we can only control what we can control. So investing in hard assets, borrowing fixed rate debt, as you said, paying that debt down with inflated dollars. I think Jason Hartman coined the term inflation-induced debt destruction. Pretty fascinating thing there. Matt, is there anything you'd like to add?
In regards to macroeconomics, I think I listen to Bruce talk about it every single day, and I'm still taking notes over here. It's like drinking from a firehouse, but no, not in regards to that. I think that's just spot on and exactly how we're positioning ourselves.
I love it. Thank you for joining us for part 1 of the 2025 Real Estate and Economic Forecast webinar. We look forward to seeing you next week for part 2. Have a great week.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.